what I do every year is I take my yearly forecasts very seriously. And in regards to mortgage rates, I actually never target mortgage rates or mortgage-backed securities or certain data lines. I only target the 10-year yield. And every single year, I try to give people a range on where I believe the 10-year yield will be so people have an idea of where mortgage rates can go. I started incorporating this in 2015. Everything was working excellent until March of 2022. And the Fed pivoted, the Russian invasion, the 10-year yield and mortgage rates accelerated higher than what we normally would see. But this year, the 2023 forecast was the 10-year yield would be in a range between 3.21% and 4.25%. If we take mortgage rates and assume the spreads are very bad, that's between 5.75% and 7.25%. So far this year, it's been between 5.99% and 7.10%. So we've stayed in that range. But for me to have the 10-year yield break under 3.21%, I would need to see the labor market start to break. For that entire forecast, it was based on jobless claims need to break over 323,000 on the 4-week moving average. Jobless claims is basically unemployment benefits that people apply for. That data line comes out every Thursday morning, 5:30 a.m. Pacific. To me, that's the very key data line at this stage of the expansion. So far, the labor market, even though it's getting softer, has not broken. So far, the 10-year yield, with all the drama that we've had this year, even with the banking crisis, kind of have a little joke. There's a certain level in the 10-year yield. I'm going to call it the Gandalf line in the sand. You shall not pass it. We've kept on bouncing off of these levels 6, 7, 8 times. So the bond market and mortgage rates looks about right to where the economic data is. And that's kind of how I track mortgage rates in the bond market on where I think the economic data would be going. So far this year, it's looked about normal. I don't believe we should get above 4.25% on the 10-year yield last year. The dollar was getting strong. We had market stress. Bond yields were rising. We peaked back then. As of now, it looks good, but to me, it's not so much about the growth rate of inflation falling as the labor market breaking. And once that does, the 10-year yield should break below 3.21%. 2.72% would be the next target. There's your case for 5% mortgage rates this year. But until that happens, I think the range has stuck and it looks normal to me with all the economic data we're dealing with.